Gold is seen as a safe haven asset. That means that it's bought by people when they're scared and when equity markets sell off, kind of like treasuries. But we'll look in this video at what those drivers are for the price of gold. And of course, it's not my job to make forecasts. That's not what I do. I provide financial education so that you can better make up your own mind about what constitutes a good investment. So why not put your own view about the price of gold into the comments below. Now, of course, if you want to keep up with what's going on in markets, what could be more easy and helpful than to sign up for our weekly market roundup? It's free and it's delivered to your inbox every week, and there'll be a link at the top of this page. So now let's look at the price of gold in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. If we look at the price of gold since 1920, you can break it down into 6 periods. Before 1970, the price of gold was fixed relative to the US dollar, and that's why the price has this blocky appearance. In 1970, the Bretton Woods Agreement broke down, and over the next decade, the price of gold increased very rapidly. This was the best period there's ever been for the price of gold so far, with an average 36% annual growth. After that huge surge, there followed 2 decades where the price of gold generally drifted downwards at about 5.5% per year. Then in the years following the dot-com bubble and throughout the global financial crisis until 2011 was another strong period for gold, with a 6.3% annual growth. Then we had 5 years when prices fell by 12% per year, and since 2016 there's been an annual growth of 11%. To place those returns in some kind of context compared to equity, I've compared the returns on gold since 1970, which is shown in blue, against the S&P 500, which is shown in red. And the average return of the S&P has been about 10% over that period, if you reinvest dividends. If you don't reinvest dividends, then the growth of the S&P has been just 7%. So although the S&P pays a small dividend, if you do reinvest it, the compounding effect over time can be huge. Unfortunately, gold doesn't generate an income, so you can't reinvest the dividends, because there aren't any. Now, I've done a whole video about gold and whether it's a good investment, where I go into the drivers in quite a lot of detail. But in that video, I discuss some of the reasons why you shouldn't buy gold. For example, it's not a very good inflation hedge unless you get hyperinflation. It's usually much better to buy inflation-linked bonds. And as a hedge for equity, US Treasuries tend to do a better job. And one of the difficulties with gold is that because it doesn't generate an income, you can't assign a fundamental value to it based on a discounted cash flow analysis. So the price of gold is simply what people are willing to pay for it. And we simply can't tell whether it's expensive or cheap, as we can with equity. So let's look at the fundamental drivers of the price of gold. Probably the most important one is the real yield. That's roughly the yield you'll get on US Treasuries minus the rate of inflation. I've broken down the period since 1970 into 3 levels of that real Treasury yield. When it's high on the right in blue, when it's medium in the middle in green, and when it's low on the left in red. And on the y-axis we have the annual return for gold. Now this is called a violin plot, and the width of the bar tells you how often gold had this return for this level of yield. Now what you can see is that when yields are high, generally you got lower returns for gold. So the typical or median return for gold was negative in that case. And when real yield was low, gold returns were the best of all. Now the reason for that is that if the return on a US Treasury is far above that of inflation, then there's a very low incentive to buy gold, which offers no income at all and has a much higher volatility. Whereas if income on Treasuries is low, they offer a much less compelling investment over that of gold. If Treasuries offer no income, then their comparative advantage over gold is much smaller. Now because gold is priced in dollars, another factor is the strength of the dollar. And here again I've broken down the annual change in the price of the dollar into 3 categories: strengthening, stable, and weakening. Now the best environment for gold is when the dollar is weakening, because a weak dollar means a strong price of gold. If we do the same thing for inflation, you can see that whether inflation is low or high, doesn't seem to make a huge difference to the return on gold. And if anything, the median return on gold is negative when inflation is high. So it makes a very poor hedge against inflation. So if we break down the two most important factors, which are the US 10-year real yield on the x-axis, with positive real yield on the right and negative real yield on the left, and on the y-axis we look at the annual change in the trade-weighted dollar, with strengthening at the top and weakening at the bottom, you can see that the most toxic combination for gold is when the real yield is very positive and the dollar is strengthening. And that's why a lot of these dots are in red. And that shows a negative annual change in the price of gold. Conversely, the best environment for gold is when we have a negative real yield and the dollar's weakening. And that's when we have more of these blue dots, which means the price of gold is increasing. And the size of the dot tells you the absolute change in the return on gold. At the moment, we've got a negative real yield on the US dollar and the dollar is strengthening. So we're in this quadrant. But if we move into this bottom left quadrant, gold will be in an even stronger position based on these two variables. If we apply a time label for those points, you can see that the worst returns was when we had very high real yields, and that was in the early to mid 1980s, whereas the best returns were in that fantastic decade just after Bretton Woods collapsed. If we apply a similar analysis, but here we've got US GDP growth on the x-axis and inflation on the y-axis, you can see that the US economy has spent most of its time with positive growth and positive inflation. Unfortunately, there weren't any periods after Bretton Woods when we had deflation, or at least not over an entire year. But at least in theory, this should be one quadrant when gold does particularly well. Now let's look at positives for gold given the current macroeconomic environment. One measure of real yield is the yield on Treasury Inflation Indexed Securities, or TIPS. You can download this series for free from the Fred website, and the identifier is here in the bottom right. And at the moment you can see that we've got negative real yields, which, as we've seen, is a positive for gold. The low income on Treasuries offers a very poor alternative at the moment. Another reason why gold is in a very good place at the moment is due to economic policy uncertainty. Now, fortunately, there's an index for this based on textual analysis of 10 US newspapers. So that would include USA Today, the Miami Herald, all the way through to the Wall Street Journal. And this index scans for combinations of words which suggest uncertainty. So, for example, a combination of the word uncertain and economy, and things such as regulation, Federal Reserve, or deficit. And you can see that during stress events such as Black Monday, the Gulf War, and so on, this economic policy uncertainty index tends to spike. Again, this index is available via the Fred website, and the identifier for the series is here in the bottom right. If we overlay the VIX index, which is a measure of implied volatility for the S&P 500, you can see that it correlates fairly well with the values of the uncertainty index. So in 2008, when uncertainty was high, equities sold off and the volatility increased. And the recent crisis is certainly no exception. If we zoom into the most recent data from that graph, since the end of 2019, what's clear is that since the Fed intervened in March, equities have rallied strongly and volatility has been falling. However, at the same time, uncertainty has remained high. And in this environment of uncertainty, that tends to favour safe haven assets such as gold. Now let's look at the current negatives for the price of gold. We saw that when the trade-weighted dollar is strong, that tends to be a negative for gold. And quite recently, we've seen the dollar strengthen. That's a typical reaction when equity markets sell off, because when people are scared, they tend to move back to safe haven currencies such as the US dollar. So if the dollar remains strong, that'll be a negative for gold. One of the primary drivers of dollar strength is a relatively high interest rate that US Treasuries have been paying versus government bonds in the rest of the world. So 10-year Treasury yields are shown here in blue versus UK 10-year rates in green, and this is Germany in red, and Japanese yields here at the bottom. Although it's still true that the US Treasuries are relatively high in terms of yield, the dispersion relative to other developed market government bond yields is getting smaller. And if yields continue to converge, then we might expect the dollar to weaken relative to other developed market currencies, which would be a positive for gold. One source of demand for gold, which pushes up its price, is a demand for gold for jewellery. You can see that's been fairly steady over time, but also that demand from India, which is in green, and demand from China, which is in black, constitute about half of the global demand for gold for jewellery. During this crisis, that demand has completely slumped to record lows, and that's certainly been a headwind for the price of gold. Now, one of the great things about ETFs is that we can very accurately measure the flow of money into the funds and out of funds as a measure of sentiment. And for gold exchange traded funds, the World Gold Council monitors that on a monthly basis. And since this crisis, there's been a very strong demand for gold ETFs, and money's been flooding into them. North American demand is shown in purple, and that's made up about 70% of the increased demand since the crisis began. So this is clearly a very popular trade and a very crowded trade. So now let's look at some of the gold funds which are available. The largest gold ETFs in the United States are the Spider Gold Trust, ticker GLD, which has $62 billion in assets under management, and the iShares Gold Trust, which is about a third of the size. And then there's a very long tail of other funds which follow. But it's rather surprising that the expense ratio for these large funds is extremely high, particularly for the very popular GLD. So it may make sense to go for one of these low-cost gold funds which have a much lower expense ratio. After all, there's no special type of gold. It's completely commoditized. So I think it's very hard to justify such high fees for some of these funds. If we look at the fact sheet for IAU, which is the iShares Gold Trust, you can see it tracks the LBMA gold price, which is a gold index. And as more people buy the fund, then BlackRock goes out and it buys gold, which it stores in a gold depository. And currently, you can see that it holds 391 tons. Now, although gold does diversify your portfolio if you hold equity, as we've already seen, it's not a great inflation hedge. So that's probably not a good reason to hold it. But the beta versus the S&P 500 is about 0, which suggests that over the long term, gold is a good equity diversifier. In the UK, these are the 5 largest gold funds. Notice that the most popular is denominated in euros, and the other 4 are denominated in US dollars. So for a non-US investor, you will be taking your domestic currency risk versus US dollar. And again, you probably want to go for one of the lower expense ratios. This is what the fact sheet looks like for the most popular one, which is available on the London Stock Exchange, which has ticker SGLN, again issued by iShares. This holds about 203 tons of gold, and it's eligible for your ISA and your SIP, which means you can hold it in a tax-efficient wrapper. Now, some people like to buy physical gold, but there are certain disadvantages that come with that. Firstly, you have to pay some kind of storage cost. If you don't keep it in your house, you might keep it in a safety deposit box at a bank, and that will incur a cost. Also, you may not sleep well at night if you've got gold bars buried in your garden. Compared to buying via a fund, you may find that the trading costs for physical gold are also higher. It's not as if you could walk to your local shops and sell a bar of gold at a very reasonable price. Also, the time taken to sell your gold can be considerable because you'll probably have to send it via secure delivery to a gold broker. In other words, the liquidity of holding physical gold is very low. It could take a while to turn it into cash, whereas you can liquidate a fund in just seconds while markets are open, usually very cheaply and at a small bid-offer spread. So I think the case for gold as part of your portfolio is stronger now than it has been for a while, particularly if you want to hedge in the case that the equity markets do sell off and things get worse before they get better. If you found that video useful, please do consider supporting us on Patreon. For just $10 a month, you get access to all sorts of goodies, such as our Sunday evening call. And you can see an example of one of those calls. You get access to those notes and also the video replays of all previous calls. And we've got quite a big backlog of them now. The notes are quite detailed and you get links to the things we've discussed so you can research them yourself in more detail if you want to. Also, you can ask a question at any time you like via the chat application Slack, and you can talk to other members of the community or to me if you want to ask a question. So I hope to see you soon on one of those Sunday evening calls, and as always, thank you for listening.